Business ownership is the best way to build wealth, and buying a business is the fastest way to get there. And we get a lot of questions about legal structures like S Corps, trusts, LLCs, C Corps. Now, the primary benefit of most of these is that liability protection, but like it says in the name, limited liability. It reduces some of your exposure to things like lawsuits, or if the business were to default on a debt, it can protect your personal credit. But the protection is rather small. I mean, you can't commit fraud and not be liable if you did it through an LLC. Most lenders are not going to lend money to your entity. You can't go and create an LLC online overnight and then go and get a loan. You're going to have to provide a personal guarantee. So then if the business defaults on the loan that you've given a personal guarantee, it's really just like you defaulting on the loan personally. So that liability protection is rather small. It's still worthwhile. They're super easy to set up. If you're a startup, you can go online and just do a simple one. But once you have employees and revenue, you should definitely have an actual attorney go through and do the work and make sure everything's set up right. And definitely if you're buying an existing business, you should go and have an attorney examine your situation, help you determine which structure you should use, and make sure that all the documents and everything's done correctly. Typically, an attorney might charge about $1,500 for a full package. It might be less, it might be more, depending on where you are and depending on your attorney. So now one of the biggest factors that differentiates the different types is how they're treated for taxes. So most are what are considered a pass-through. So if you're a sole proprietor, if it's an LLC, if it's an S Corp, all the taxes pass to the owner. But if it's a C Corp, you pay taxes at the corporate level. Those taxes are not passed through to your personal tax return. And it's just important to note, on TikTok, they like to show people putting lots of layers of entities, mixing some trusts in and some corporations. Everything continues to flow. So whether you have one LLC that's generating income and you the taxpayer, or you have an LLC at the top, 100 other legal entities in between you and where the revenue is generated, it still just all flows through, and you just have to pay like extra layers of administration and expenses and filings for each one of those layers. So typically when you see recommendation for layering, it just doesn't make any sense. It doesn't save you any money in taxes. It just adds administrative costs. So looking at the different pass-throughs, the really only time you get a different tax structure is whether you have an S Corp compared to a LLC or a sole proprietorship. So the main difference is once you take an S Corp election, your earnings can essentially be broken into two categories. So one would be the salary that you earn for running the business, and two would be essentially the profits that you earn as the business owner. And the difference is the salary that you earn can be subject to self-employment taxes, which are 15.3%, and the profits that you earn from owning the business are not subject to that self-employment tax. So for example, let's say you had an LLC that had $160,000 in profits. 100% of those profits would be subject to that 15.3% self-employment tax. Now, the good news is that Social Security maxes out at that level. So once your income crosses that $160,000, you also no longer owe self-employment taxes. And that $160,000 cap goes up every year. Based on inflation, that's the 2023 number. So now for the S Corp, you do have to pay yourself what is called a reasonable salary, and there are certain tables and guidelines to help you set that up. But then you only pay that employment tax on that reasonable salary portion of your earnings. So again, for simplicity, let's say you earned $160,000 in profits in your business. And let's say your accountant says that an $80,000 salary is a reasonable salary for what you're doing in that business. So then you pay self-employment taxes on the $80,000 that's considered your salary, but then you do not owe the self-employment taxes on that $80,000 that is considered profit of the business and not part of your salary. And the tax savings from not paying the self-employment tax on that $80,000 is a little over $12,000 per year. But do keep in mind that that self-employment tax does cap out. So if you're running a really large business and your reasonable salary is over the $160,000, some of that benefit is greatly reduced because you weren't going to pay self-employment on a lot of your income anyway. There are some much more detailed tax differences from the LLC and the S Corp. And once you're getting into that, you really just got to sit down with an accountant and attorney to get into the more detailed information. But the self-employment tax situation is probably the biggest difference between, say, an LLC and an S Corp election. And hey, if you don't have an attorney or an accountant, reach out, we'll help you find one. And the other more common legal structure is a C Corp. Now, most public companies are C Corp. So Apple, Microsoft, Google, General Motors, General Electric are all C Corps. C Corps pay taxes at the corporate level rather than passing them through to the individual. But there is also a layer of double taxation. So if that C Corp pays out a dividend, cash to you as the shareholder, you have to pay taxes on that, but it's at a specific rate for dividends that is lower than the normal income tax threshold. Now, there are a few reasons why you might structure your small business as a C Corp, even though it's typically used by large corporations. For our audience, the most relevant is probably the rollover as a business startup, or ROBS structure. And what that is that's if you're using assets within your retirement account to purchase your business or make the down payment for the business. Because that asset is owned by your retirement account, and retirement accounts don't pay income tax, the government wants their money. So they say that the only way that you can structure a business that's held in a retirement account is through that C Corp structure. So that way they get to collect their income tax, even though the assets held in a tax-free account. And we do have a really good video that talks about ROBS. We walk through an example. Shoot us a message if you want us to tag you in that or point you in that direction. Another reason you might use a C Corp is if you're planning to raise venture capital money. Venture capital firms just prefer C Corps. They're just a lot simpler. Back when I worked at a private equity fund, it was really a pain when we had a business structured as an S Corp. It was really simple when they were structured as C Corps. And it was just more just because it's just easier for us. Like, that's why venture capital wants a C Corp, is it's just easier for them. And another reason you might use a C Corp is if you're raising money as what's called a qualified small business stock, QSBS. I think this structure is probably beyond the scope of this video, but that's a way that you can raise money and essentially make the growth of the business tax-free for the investors. So if you're typically used if you're looking for a high growth startup, but it could be used in other situations as well. Basically, you only register as a C Corp if you have to. If you don't have to register as a C Corp, you probably want to use one of the other structures because you get some benefits of losses flowing to you personally. It opens up a lot of different things that you can do to help reduce your taxes if you're in one of the pass-through structures versus in the C Corp structure. Now, there are other less popular legal structures out there that we won't talk about today. So reach out if you want to talk more. Let us know if you have any questions or other types of businesses you want us to cover.